the investments or most of the securities what we consider for investment, we deal with the two important characteristics to be dealt are risk and return, right? So return is the amount of money what we get. Say suppose if you invest in equity, right? The return comprises of two forms. One is the dividend what is being paid by the company. The other one is the capital gain. So dividend generally the companies announces every year in their AGM, right? Or sometimes the companies may also pay quarterly. The capital gain is the additional amount. Or suppose you bought a share at 100 and the share price increased to 120. So this 20 rupees of difference from the price what you purchased is called as capital gain, right? So in equity, right, we have two forms of returns. One is dividend, the other one is capital gain. Suppose if you invest in a bond, right, the issuer of a bond promises the regular payments and in the form of coupon, right? So when you invest in a bond with 1,000 face value at 10 percentage coupon rate for 10 years of maturity, what happens is the issuer will pay you 100 rupees, 10 percentage of face value, that is 1,000 every year, right? So that is the return what you get in the bonds. So now when it comes to risk, so if it is a return, when we are talking about dividend capital gain, there might be some variation in these returns, right? So there might be some variations in the returns. So if you calculate the variability of these returns, if you calculate the variability of these returns, we'll get risk. So the standard measure of risk, we have like the range, we have standard deviation, right? We have coefficient of variation, right? So, but widely used measure of risk is standard deviation, right? Which takes xi minus x bar whole square by n minus 1 under square root, right? So, risk is calculated in finance. Generally, we calculate risk using standard deviation. So then it comes to valuation of common stock, right, and valuation of fixed income securities. So what does it mean is in any concept of valuation, right, any concept of valuation, what we are supposed to let it be equity in the form of common stock or let it be fixed income securities. What we do is we'll try to find out today's value. In a valuation, what we do, we'll try to find out what is the value of that stock or fixed income security today given their future cash flows, right? So as we discussed, the equity or common stock pays dividends, so we expect the dividends in the next say 10 years or 15 years, right? So expecting these dividends for the next 10 years, 15 years, what is the value of that stock today? That is what we do in the valuation of common stock. In valuation of fixed income securities, what we do is, again, when I talk about fixed income security, I'll get the fixed amount of coupon every year, right? So when I know that I'll get 100 rupees after 1 year, 100 rupees after second year, 100 rupees after third year, like this for 10 years, what is the value of this fixed income security today? Given your required rate of return, what is the value of this fixed income security today? That's what we do in the valuation of common stock and valuation of fixed income. Valuation is nothing but the value of a particular asset today, given their expected cash flows in the future, right? When it comes to third block, the securities analysis. So there are two widely used analysis. Let it be any type of investment. We go with fundamental analysis or technical analysis. Right. So in fundamental analysis, you are supposed to go either top-down approach or bottom-up approach. In a top-down approach, what we do is we'll first analyze the economy, then industry to which the company belongs to, then we get into the company analysis, right? Suppose I want to analyze Dauber, then what should I do is I should look at the broader economy as what's been happening. Let it be, maybe general elections, unemployment, inflation, exchange rate fluctuations, current account deficit, right? Like this, these are all the macroeconomic variables what I need to study. Once you study the economic analysis, then it comes to the technical analysis. Sorry, the industry analysis. So Dauber as a company falls uh, in a FMCG industry, fast moving consumer goods industry. So you need to understand the issues related to FMCG industry. So we can use either Michael Porter's 5 force or maybe the SWOT analysis to understand the industry in much better manner. So you need to understand what are your competitors doing, right? So what are the revenue drivers? What are the cost drivers? How the small players in FMCG industry can take away your profits. So you need to analyze a lot of other issues, right? To understand the industry in a better way. Once the industry analysis is done, then you're supposed to get into the company analysis. That's what we do in the fundamental analysis. In a top-down approach, we start with economic analysis, then industry analysis, then the company analysis. In the company analysis, again, we do the two types. One is qualitative analysis, the other one is the quantitative analysis. In a qualitative analysis, what we do is we understand the company, we understand the company in a qualitative way, right? So how the management is been doing, what are the recent decisions they have taken. In a quantitative analysis, what we do is we'll go for the ratio analysis, right? That's what we do the fundamental analysis. In a top-down approach, first we start with economic analysis, industry analysis, then company analysis. In a bottom-up approach, what we generally follow is we follow the company analysis, industry analysis, and company analysis, industry analysis, then we go for economy analysis. Right? So that's what we do in the fundamental analysis. And technical analysis, right? It is irrespective of the security. What we generally do is we only deal with the price and volume, right? How much is the price and how much is the volume of that asset traded. Let it be equity, let it be gold, let it be any asset. We least bothered about the asset in technical analysis. The two important factors what we need to know in technical analysis are the price and volume, right? So in efficient market theory, what we do is we assume that the markets are efficient, but in reality the markets may not be efficient, and we have three forms of efficiency: weak form, semi-strong, and strong form. The weak form, the asset prices reflect all the past information, right? In the semi-strong form, right, it reflects only the present information as well as past information, historical information. And if the markets are efficient, right? If the markets are efficient, it reflects the private information also, right? Suppose if something very important going to happen to the company, that will always be reflected in the stock price if the markets are efficient. But in reality, most of the times markets may not be perfect, right? Let it be US, let it be India, right? We do not find the perfect markets or efficient markets. Right? So when it comes to portfolio theory, we have portfolio analysis, right? So when we're talking about risk and return here and valuation, right? So we'll be dealing only with one asset at a time. So what is a portfolio? It's a combination of assets, right? The combination of assets. Let it be the equity, debt, right? And in equity again, you can have the stocks of Infosys, TCS, Reliance, right? So the portfolio is the combination of assets, and the basic reason why we need to construct a portfolio is to diversify our risk. Instead of investing the entire amount of money in a single stock, what we do is we diversify our investments into various stocks. Not if you are if you would like to diversify, you need not to restrict to only the various stocks. You can also diversify into debt, you can diversify into commodities, you can diversify into the other assets, let it be real estate or maybe the alternative investments like real estate, gold, right? The private equity, right? You can diversify into various assets. That's what we create a portfolio. And in portfolio analysis, what we do is instead of calculating the risk and return of a single security, we calculate the portfolio risk and portfolio return. Right? So we have single index model where we would like to calculate the expected return on a stock using one factor. And in factor models, we have the CAPM, which is capital asset pricing model. Then we have arbitrage pricing theory and Fama French three-factor models. So once you understand the portfolio theory, then we'll get into portfolio evaluation. What we do, we'll evaluate the performance of portfolio. And in some cases, what happens is if your portfolio is not meeting your expectations, we'll have to go for a revision of the portfolio. And in chapter 15, unit 15, what we do is institutional and managed portfolios. This is more about the mutual funds. Right? Hope you are with me. So just let me. So if you see this, the entire valuation is about this, right? The general belief is that the value of any asset or security is exactly equal to the discounted present value of all the cash flows that can be derived from its future period. That's what I told you. No? When you're talking about valuation, what we do is we'll try to calculate the present value. We'll calculate the present value of an asset, let it be security or equity or fixed income, by by discounting all the cash flows that can be derived from it in future periods. So, as I mentioned earlier, it can be dividends or it can be coupons, right? We discount all these cash flows to get the present value. So, the basic difference again, is the cash flows derived from the debt can be easily predicted because it's a fixed income security. So the coupon payment will be same throughout the maturity. But equity valuation is not simple because the dividends what you're supposed to receive is not fixed. But of course, we make certain assumptions and we'll value the equity also. The equity represents a partnership in a business, right? So you know the basic difference between equity and debt is equity shareholders will get the ownership rights or voting rights in the company, whereas the people or the investors who invest in fixed income securities of the company, just they are liable to get uh, only the interest. They don't get any voting rights. Suppose if you see here, your father gave you 100 on your 10th birthday, you deposited the amount in a bank at 10% rate for 1 year. How much future sum would you receive after 1 year? Generally, what we do, if 100 rupees is invested for 1 year at 10 percentage interest rate, you'll get 10, right? You'll get 10 in the form of interest. So the total amount of money what you have in your account after 1 year will be 110. But if you invest the same amount for 2 years, then what happens is it will become 121 because for the second year what happens you'll get the interest on interest which is called as compound interest, right? Which is we have seen in calculation of future values, right? So when you would like to invest for 2 years it is future value, right? So just let me write here, future value is equals to present value into 1 plus r power n, right? So if you invest for 2 years, this 100 rupees what you invested, right? 100 if you invest 100, that is the present value, right? If you invest for 2 years, it is at 1%, so it will become 1.1 to the power of 2, right? So it will become 121, right? So now if you observe this difference, right? If you observe this difference, so for the first year it became 10 rupees more than what you invested. And if you invested for 2 years, it has been increased by 21 rupees. So what happened in the second year? The amount of interest for the second year is being calculated on the principal as well as the interest what is accrued for the first year. So that's the reason why you keep, if you invest money in a compounding issue, then you'll get more benefit, right? So the basic reason why we need to study this is the time value of money, right? So if somebody says I'll give you 120 rupees after 2 years or 100 rupees today, right? So you can better take 100 rupees today instead of 120 rupees after 2 years if you are able to invest this 100 at 10 percentage, right? Because if you invest this 100 at 10 percentage for the same 2 years, what happens? It will increase to 121 rupees rather than receiving 120 after 2 years. It is better you receive 100 today and invest at 10 percentage interest rate for 2 years so that you'll get 121. So person may accept less today for rupee to be received in the future. For the same amount of money what you would like to receive, it's better you receive less today and invest. Right? So this is what we have seen is the future value, and the exactly opposite to this is the present value. That's what we use it in the valuation, right? So when you know the future value, that is 121, right? So what is the present value? Present value is equals to future value, that is 121 divided by 1.1 to the power of 2, because you are investing for 2 years, right? What happens is you're taking the discount rate here, it will become 100. So what does it mean is if you invest 100, it will become 121, or if you know 121 is the amount what you are going to receive after 2 years, and if your required rate of return is 10 percentage, and the value of that asset today should be 100. So this is how we calculate the present value of an asset, right? Let it be equity, fixed income. Though you might be having different cash flows, you should know the time at which the cash flow is occurring, right? And accordingly, you discount so that you know the present value. What is the meaning of this is if any asset promises 121 rupees after 2 years, if any asset that promises 121 rupees after 2 years, and if your required rate of return is 10 percentage, the maximum amount what you're supposed to invest for that asset is 100. If it is available at 98, right, you buy it. But if it is available at 1 or 2, don't buy it. So you should be able to know whether the asset is overvalued or undervalued by calculating the present value of the asset given the future cash flows. That's where the valuation lies, and that's where the use of time value of money comes into picture. Right? So cash flows realized at the present, right? The cash flows realized today will have a greater value to investors than the cash flows realized later because of the following two reasons, right? So inflation, and if you wait, right? So suppose if I say 100 rupees today or the same 100 after 1 year, right? Because of the inflation, your purchasing power decreases. So it's always better to receive 100 today rather than receiving the same 100 after 1 year, right? The other one is risk, right? So if somebody promises 100 today or 100 after 1 year, so the risk involved is more in the second case where the other person is promising you to pay 100 after 1 year. So it's always better to take 100 today because it is uncertain whether the same person will pay you or not after 1 year. So this is what we have seen. The present value is cash flows divided by 1 plus k power n. That's what we have seen. The 121 divided by 1 plus r to the power of or 1.1 to the power of 2. Right. Suppose if you see uh, the maximum a rational investor would be willing to pay for an investment yielding 9,000 cash flow in 6 years, assuming a discount rate of 15%. Right. So what does it mean is if any asset, let it be insurance, right? If it is insurance or post office saving, right, whatever it is, if it promises 9,000, so of course, let me take it as 0.5 percentage here because, right, oh, it is should be 0.15, right? So 0.15, right? Because it's a 15%. So if an asset promises 9,000 after 6 years and if your required rate of return is 15%, the maximum amount you should invest is 3890. If that asset is asking for more amount, then you should not take this investment. Right? In the same way as we discussed, right? So if it is multi period, right? So instead of 6 years or 4 years, what we discussed, suppose if an investment is expected to yield the annual cash flows of 200 for each of the next 5 years, right? So this is a 200 what we are going to receive after 1 year, 200 after second year, 200 after third year, like this, right? So the maximum amount you are supposed to pay for this asset is 865, right? So you might be wondering, right? 200 5 times you are receiving 1,000, but we are investing only 866 rupees, right? The reason is the 1,000 or 200 what you are going to receive in every year for the next 5 years, right? And if your discount rate is 5%, the value of these five cash inflows is equals to 865. So what you're supposed to do, if somebody asks you or somebody tells you that I'll give you 200 every year for the next 5 years, do not be under the assumption that you are going to receive 1,000. The actual value of this five 200s is 866 if your required rate of return is 5%. So the maximum amount of money what you're supposed to invest is 866 rupees to receive 200s 5 times at the end of each of the next 5 years. Hello? 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 So we have different dividend valuation models, right? In a simple model where we assume that there is a constant dividend with no growth, the value of the stock or value of the equity is D by R. D is the amount of dividend which is constant, that divided by cost, right? So V is, right. Suppose if I tell you that the company would like to pay 2 rupees dividend every year, right? And if your required rate of return is say 10 percentage, right? What does it mean is V becomes 20, right? V becomes 20. So what this V indicates, this should be the maximum price you are supposed to pay to acquire that security. Suppose if the security is trading at 22, do not buy it. If the security is trading at 18, it is underpriced, so you buy it. Right? So that's how you are supposed to take the decision in the simple dividend valuation model. If it is a model with growth less than the required rate of return, right? We have added one more term here, G, which is a growth in the form in the dividends, right? So V is equals to dividend by R minus G, right? Dividend by R minus G, where R is the required rate of return, G is the growth in the dividends, right? Suppose if there is a high growth companies, right? V is equals to the price of the share today is, we represent with P0, which is D1 by R minus C. D1 by R minus C. This value of the price of the stock today, D1 by R minus. Right? So this 1 year holding period is, so when we expect a dividend of, right, how much is a dividend? 1 rupee, right? So the return on a stock is comprising of, or otherwise we can calculate like this. Return on a stock is D1 plus P1 by, this is today's price. One plus KE, right? And this comprises of two things: dividend by 1 plus KE, which is the dividend yield, right? P1 by 1 plus KE, which is the capital gain yield. So the return on a stock comprises of two things: the dividend yield and capital gain yield. D1 by 1 plus KE is dividend yield. P1 by 1 plus KE is capital gains yield. So the total return is 0.04 plus 0.06, which is 0.1. That's 10%. So in earnings valuation, what you do is you calculate price earnings multiple, and based on the price earnings multiple, right, you decide whether the stock is overvalued or undervalued or fairly valued. Right. So we, where P stands for market price of the share, E stands for earnings per share. In cash flow valuation, right? So net of inflows less outflows from operations. So you'll take the cash flows differ from the book. Generally, the cash inflows minus cash outflows gives you the net inflows, right? So you'll take the free cash flows to the firm or free cash flows to equity. When we're talking about free cash flows to equity, sorry, equity valuation, it is always better to take the free cash flows to equity, FCF. So when we are going with asset valuation, it is better to go with book values because most of the times assets are written at book value. And dividend discount model, we have seen this, right? So where the dividends are discounted, and when it is zero growth model, the dividends won't grow, so G will become zero. We will just solve this problem. We will see the CAPM, which tells that expected return on a stock. Expected return on a stock is equals to RF plus beta into expected return on market minus R. This is how we will calculate expected return using CAPM. Beta is the sensitivity of the stock to the market. RF is risk-free rate of return, and this is expected return on the market, right? We will calculate expected return on the stock. So if you see this, a bird in hand worth are more preferable than two birds in the bush. What is this? Is this more about the time value of money, right? So we discussed time value of money, right? Suppose if you see the firm has paid a dividend of 2 last year, right? The expected growth rate of dividends is 5%. Determine the estimated price of the share if the growth rate of the share rises to 8%, right? So it is 2 into 1.08. We'll solve this. Share whose current cash dividend is rupees 4. So D0 is 4. D0 is 4. And the growth rate in the dividends is 15%. So I'll take it as 0.15. And the required rate of return, that is R, which is 20%. Now, what is the price today? Price today is dividend after 1 year, that is D1, dividend after 1 year divided by R minus C. Right? So dividend after 1 year is today's dividend into 1 plus growth rate in the dividends, right? 1 plus G power 1. Because we are calculating D1, it is D0 into 1 plus G power 1. So G is given 0.15, so 4 into 1.15 divided by zero point 0.2 minus 0.15, which is 92. So what is the meaning of this is, if there is a stock which pays you a dividend of 4 rupees today, and if the expected growth rate in the dividend is 15 percentage and the required rate of return for you is 20 percentage, then the highest amount of money what you're supposed to pay to purchase the stock should be 92. If it is priced at 94, 95, then you should not invest in the stock. And if the price of the stock is less than 92, it is better you buy the stock, right? So this is how the security valuation or the equity valuation goes, right? So if you have any questions, please ask me. Anil Kusharani garu. So please let me know if you have any questions.
సార్ నో డౌట్ సార్.
Okay.
సార్ ఇంకొకటి ఏంటంటే నాకు నోట్స్ కావాలి సార్ అంతే.
That నేను ఐ స్పీక్ టు కిషోర్ అండి.
ఓకే
ఎందుకంటే
సార్.
సాఫ్ట్ కాపీ మీకు ఇవ్వలేదా? ఐ
ఇవ్వలేదు
థింక్.
సార్.
ఓకే, వాట్ ఈస్ ద బ్యాచ్ సైజ్ యాక్చువల్లీ?
సార్
స్ట్రెంత్ ఎంత ఉంటుంది క్లాస్లో, మీకు ఏమైనా ఐడియా ఉందా?
లేదు సార్.
ఓకే, నేను ఈరోజు ఐ స్పీక్ టు కిషోర్,
ఓకే.
ఈజ్ అ కోఆర్డినేటర్. సో
ఓ-
నేను అడుగుతాను తన్ని ఒకసారి, కెన్ ఐ షేర్ ది సాఫ్ట్ కాపీ టు యూ? ఇఫ్ సేస్ ఓకే, దెన్ ఐ షేర్.
ఓకే సార్, థ్యాంక్ యూ.